Hi, this is Randy Finney with the Right Side of the Chart, and today is Friday, October 7th, 2016. It's a little after 11 o'clock Eastern Time as I'm starting this video, and I wanted to do an overview of the U.S. markets, equity markets, in particular the Qs, the Nasdaq 100, QQQ, and something I've done in the past for years, and I've sort of gotten away from lately. Every now and then I would do an overview, a brief video overview of the top 10 components of the Nasdaq 100. As I often state, that the top 10 components alone make up for over half the results or the returns, because those top 10 stocks have such a heavy weighting. So if you want to know where the Qs are going, or the Nasdaq 100 that is, you just need to get a good read on the charts of the top 10. And if you know where the Nasdaq 100 is going, you can tell where the market's going, because this has been the leading index for years, for many years. When the market goes up, it leads on the way up. When the market goes down, it tends to lead on the way down. So let's take a look at the individual charts. We'll start out, of course, looking at the charts of the QQQ and or NDX, and then roll into the top components. And we're starting out here looking at a 60-minute time frame. I know this is busy. I'll show you a clean version of this chart in a second. But something I've mentioned recently, we've been in, this is a 2.5-month sideways, or I'm sorry, a 2.1, just over a 2-month sideways trading range we've been in. This whole trading range up here that I've highlighted for a while. So the market has gone virtually nowhere for over 2 months now, and as such, what I've mentioned is you can't really take any these 60-minute trend indicators and the price momentum oscillators and indicators become useless. They're flatlined like an EKG. So at this point, all we can really ascertain from these 60-minute charts, we can look at these charts. I still think there's value, but mainly up here on the top on the price action. And I'll go into the long-term charts, because that really helps give us a cue as to where the next direction, the next major trend in the market might be. So what I'm looking at this point, here's that sideways trading range. You can see this shaded box here. So I move it up and put it right here. What's happened, and again, this is just a quick rehash. I think we're all familiar. We had this breakdown about a month or so ago. It looked like the real deal by all accounts. High volume, impulsive selling, everything else proved to be a failed breakdown, or a whipsaw signal. Prices shot back up. Now, normally, especially after such an extended trading range, even at that point, we had a long, very tight trading range. One would expect that if you were bullish and thought the market was going higher, or if there was, let's forget about what you think, if the market itself had a strong bid beneath it, in other words, more pent-up buyers or potential buyers and sellers, what you usually see on a failed breakout, I always say this, fewer things in trading are more powerful than a failed breakout, whether it's bullish or bearish. And what you normally see is a quick reversal after a failed breakdown, like in this case, you call that a bear trap. Shorts pile in, might run some stops of some of the longs, and then you see a very strong move to the upside. We did actually shoot above that channel, but we limped above there, fell back in, and trading has been very muted since. In fact, we're barely above the top of the channel. So all this has really done is extended the trading range, to a little bit larger amount. And if you exclude that little breakdown there, this is what we're looking at now. So from a 60-minute perspective, what I'm watching for right now, here's a trend line that I'm keeping an eye on. It appears that the Qs are wedging up somewhat. You have this divergence here. You do have divergence. We'll draw it out. As I said, it's hard to take too much from the indicators when they're flattening out like this. But with that being said, this is negative divergence, as you can clearly see here. I'm drawing it on the MACD, the RSI, and my 1333 trend indicator, which is close to crossing back into bearish territory. Again, for the intermediate time frame, 60-minute chart. So our first signal, sell signal or bearish event would be a break of this downtrend line, also move back down to within the range. Now there's work to be done. I mentioned the midpoint of these trading ranges often act as support and resistance when tested from above or below. So we have about the 117, 117.23 level there. It's been sliced through. I would put it as on a scale 1 to 5, maybe a 2, no more than a 3 as far as how good of resistance or support level that is. 116 is still a big level, even though it was violated once. That still has contained this trading range. So there's what we're watching for. This, as each level goes, if the Qs do break down here and continue down below all these support levels, especially that 116, that will strengthen the bearish case. And for the bulls, there's these divergences can be undone. They're not going to be undone anytime soon on the daily time frame. The weekly, that's what we'll get to here in a minute. But here's the recent highs right here. So on face value, is a breakout to new highs in the Qs bullish? Absolutely, that would be, especially if it's sustained, not a little intraday pop through there and a failure back down below. But you have to take the markets as a whole. You have to look at the S&P 500, which is far off its highs. This is what I'm talking about here. There's a lot of divergence in the stock market right now. It's just those big mega cap tech names holding the market up. Google, Microsoft, Amazon, Facebook. Same thing I saw at the top of 2007 when fewer and fewer mega cap beloved tech names were lifting the market. We're seeing breadth deterioration, things I've already pointed out, and that's why a break in the even if the Qs were to pop above this level, until I see the rest of the market catching up, I wouldn't put too much stock into that. All right, let's take a look, zoom back out on to daily time frame here. Again, pretty busy chart, but the story is told here. Each of these divergences down below, bullish or bearish, they play out more often than not. I would say, when you have a confirmed divergence, you've heard my term, my definition with the second react. We need to see this right here on the MACD clearly turn down, make a bearish cross, and turn down lower, confirm this most recent bearish divergence. But we have this big, powerful divergent high right here. You might not be able to make out that trend line. We'll color it for you here. We have a strong divergence. I've mentioned this many times over in the S&P 500 and the Nasdaq 100. These are powerful divergences that don't indicate a 5 or 3% correction or even a 10% correction. They indicate something much more, just as we had back here. So I've gone over this. If you're new to the site, you'll just please reference some of the more recent market updates. I don't want to beat a dead horse here for those of you that have heard this 100 times over. And on that same note, it gets to at times feel like the the boy that cried wolf, the Aesop's fable, where the boy cried wolf, that there was no wolf coming. He was guarding his sheep, and one day the wolf finally came, and the villagers didn't come down because they didn't believe him. So this is what I fear, that a lot of people have become complacent or numb, or just dismissed these divergences, things that have always played out in the past for powerful corrections. I've covered this many, many times, and this is a long-term chart. I just flipped to a weekly chart of the Qs. We have this primary uptrend line right here. This yellow uptrend line. Again, this is a busy chart. Some of these are a little more clean, these boards, not on the Qs. I might have it on the NDX. So this one you can see. So you have a primary uptrend line here, breakdown, back test. You have a secondary and a tertiary uptrend line, or two minor uptrend lines, we'll call them. And you can see prices are behaving well. They've broken down, they're back testing, the divergences are still in place. And you can see most recently this big powerful divergence from this point all the way to back here. That really, this high right here, I know it's hard to see. There's so many colors. Let's see if I can give you a different view of the Nasdaq 100. It looks similar, but you get the point. From this point here, you had a peak back in the PPO and the RSI, all the way back here, actually. That's how you have to draw. These are a series of consecutive divergences that equal one large divergence. Prices keep making marginal new highs. Momentum is clearly waning. This was a strong advance. This is looks like a market just rolling over, topping out, doesn't have any gas left in the tank. The divergences are there, and all we need is really a catalyst, and prices start moving down, taking out these support levels, and we could be looking at one of the most lucrative short trading ops in years, many years, as a matter of fact. So that's a look at the NDX, and now let's just drill down to the top components. I know it's again a little busy for some to see all these trend lines. I just put them there because those are different support levels and things I'll need to watch. later on as if and when the selling starts. So, all right, let's go ahead and dig into the charts. We'll go through these relatively quickly. Apple, I can't, I've shared my thoughts in the trading room recently. I can't really make a very bearish case for Apple, and everyone says, well, Apple, is the big dog in the Nasdaq 100. Apple doesn't have to fall. Most people think that if Apple's doing well, the market can't drop. That's not true. I've pointed this out before. Back in when Apple topped back here in 2012, it had a 45% drop. Apple's stock price was chopped in nearly in half, and the broad market went up during that time. So as important as it is, as heavy as the weighting is, Apple is not the stock market. Right now from the longer term charts, and I've shared this, my trend indicators, I have Apple above that 40-week moving average, which is bullish. That has defined bull and bear markets when prices are below or above this red line, the 40-week EMA, which is the same as a 200 EMA. We had this bullish falling wedge with positive divergence, and we broke out, back tested. This would be a projected measurement. I don't think Apple's going that high, but I just want to share for those of you interested. If you take the distance of a wedge and you add that to the breakout point, that would be your projected target. And after the back test, we had that impulsive move up, and it appears to be flagging. So from a weekly perspective, I can't hardly knock Apple. Daily, I mentioned recently there's this bullish pennant type pattern. So you had this strong leg up, that's your flagpole recently in Apple. It's been consolidating with this pennant type formation, and it could break to the upside. And if it does, that's bullish, especially if it takes out those recent highs around almost 117. Could head on up. But I noted here we do have some pretty strong negative divergence, and this is on the daily time frame. Negative divergences on the daily time frame. I don't go long in stock. In fact, I look to position short. Not short Apple. Don't care to trade Apple right now for the reasons I mentioned, but I would have to give a higher weighting to this negative divergence on the daily chart than I would to this flag pattern, even if it pops and breaks out. Unless these divergences are burned through. So there's Apple. Again, I don't have the strongest opinion on that. Let's just say I'm somewhat neutral on Apple. Now we'll go through the rest. This is Alphabet. I'll often refer to Google. It's going to take me a while to stop calling the new Alphabet company Google. They should have changed their ticker symbol. It would have helped. Anyways, this is same story as the Nasdaq 100. You look at these divergences going all the way back. These are multi-year powerful divergences. We had a divergent high, a series of divergent highs. This most recent high is still a continuation of these divergences. It's just a series of divergences. The smaller divergences did work and play out for corrections, each and every one of them. And so far, this larger, more powerful divergence has not. And let's see if I have it. That's not really anything worth mentioning. Let's take a look at the weekly chart. That's what I'll do. We'll just look at the daily and weekly charts on each of these. So here's the bigger picture on Alphabet. You have this uptrend line. This is your bull market primary uptrend line. Goes off the 2008 lows. Quite a few of the components in the Nasdaq 100. In fact, the Nasdaq 100 itself was about the only major index that bottomed in late 2008, where everything else bottomed in March of 2009. So there's Alphabet. There's your trend line. This is the bull market uptrend line. When this goes, there's a good shot that the bull market in Alphabet is over. This chart is clearly bearish to me. I'm looking at a very large rising wedge pattern, divergent high. You have this minor uptrend line here. You can see a breakdown, and it just back tested. It's rolling over. These divergences are steep. 2 consecutive negative divergences. You can look at the PPO. It's flattening out, and the next bearish technical event in Alphabet will be a bearish crossover on this PPO. I like the PPO on a weekly time frame better than the MACD, but they work similar. And of course, if and when the 9 EMA of the PPO, the signal line, crosses below the 0 line, that will be additional confirmation. That'll probably come around the same time we see a breakdown of this primary bull market uptrend line. So when that happens, you're talking one of the leading tech stocks, one of the leading top components of the Nasdaq 100. There's the other share class, GOOG. It's pretty clear to me. I mean, these patterns are clear, and this is a a recurring common theme among the top components of the Nasdaq 100. They're confirming what I'm seeing with the index. Here's the Microsoft series of divergent highs. I noted all of these overbought readings led to significant corrections in the past. We recently had one here. We did have a correction, but in a strong bull market, you get these overbought readings. Sometimes you get a divergent high, and then you get a correction that continues on. Now we're seeing a series of lower highs. We're seeing this negative divergence, and it goes all the way back to this point here. So these are powerful divergent highs that typically mark the end of when you're looking at a weekly chart, 10-year weekly chart, they typically mark the end of an uptrend. And nail in the coffin will be a move below the primary uptrend line, just like as with most of these stocks. We'll color that one purple so you can see it clearly. And you can see a pretty well pronounced support shelf as well. So if you're trading Microsoft, once it breaks below this recent trading range, that would be most likely bring us to the bottom of this trading range here. That's why I have these horizontal support lines, and then we'll see from there. All right, did I look at the daily chart on Microsoft? If I didn't, yeah, here's the daily chart. Clear negative divergence, a series of divergences. We did have, I point out there's bullish divergence, or there was down here, that led to this rally that took us up this high, put in an even sharper, more steep, more powerful divergent high. So there's a little minor uptrend line to watch for Microsoft. And here's the recent highs. We had a double top, actually a triple top high back there that was taken out. And by all accounts, that should be bullish. The market should have ripped. Microsoft should have ripped after taking out this triple top high. But what did it do? It's limped around. That breakout has not been followed through on volume. It hasn't been followed through on price action. And if it fails, it already failed once. There's a little stick save. But if that fails, we'll probably quickly, and I expect it will, come back in. Here's a gap to be backfilled. That would be the minimum target. I mean, I think we'd come down there very quickly. And when that happens, that just across the board, you'll see other breakouts in the Nasdaq 100 failing around the same time. And things can happen quick. That's all I'm trying to say here is, I held that whole boy who cried wolf thing. One day that the big bad wolf may come and start eating the sheep, and it can be quick. So be ready. That's why I'm getting these setups out there. We could just limp around for another couple weeks. I doubt another few months anything's possible. We can go up for that matter. But the charts are clearly indicating a sizable correction or reversal in the market. So you just have your ducks in a row, have your favorite setups ready to go, ready to pull the trigger. And I know it's been extremely frustrating because we have had a few short trades we put on that looked like they were going to work out, and then the market, of course, they were correlated with the broad market, and as such they failed. But here's a big, you take a look at the bigger picture, and this is what I just highlighted on the weekly chart as well, this whole trading range here. So that would be, a very nice target. And this is an area too, you can look at all these components like the Alphabet and Apple and Amazon, and if you see all of those coming to there's comparable support levels around the same time, and you're trading, let's say QQQ, that's where you want to look in, step to cover, and make profits. When you don't have to position for a downtrend that might last months or even years and stay short the whole time. In the bear market from 07 to 09, I did great on both the major swings down and then trading long. I enjoy, in fact, bear market rallies, and even rallies during big corrections are extremely lucrative to trade. So this is what I'd be looking at, move down here and probably a bounce off this level, or at least a consolidation, so you could take some profits, lighten up, and then ultimately, if that level goes, then we probably go down and take out that next trading range here. You can see it again. I think I just highlighted this on the weekly chart. All right, Amazon. Amazon has just been a monster. Its P ratios, extremely high P ratio. But the charts are, same old story. we have this long-standing divergence. Prices keep wedging up. And again, I know it sounds like a broken record, but unless these are taken out, by taken out, you need to see the MACD and the PPO on the weekly time frame move above these previous reaction highs. This to me looks very much like a stock in its final stages, maybe even a blow off top here. It's not a typical blow off top. You're not seeing very impulsive price action. It just looks to me more like a market that's tired, that isn't going down because a lot of money is cramming into these names. And again, that makes for a dangerous market. That makes for a crowded rush for the exits when money starts finally coming out of this market. And we look at Amazon on a weekly time frame, and these charts play out just as they do if you're trading a 5-minute chart, 60-minute chart, daily chart, doesn't matter. Same technicals work on a weekly chart, and these are steep divergences. Want to see that PPO, it's sort of flattened out recently. Want to see that turn down. That'll help to firm up these divergences. And there you can see how steep that the divergences are. You have prices making this higher high, indicators making lower lows. There was one little minor uptrend line, didn't really play out for anything, so you'd probably want to extend that out at this point. That's not the best trend line. I like to see at least 3, if not 4 reactions. But either way, something to watch. And again, I'm not picking on Amazon. I'm not short Amazon. I have no desire to short Amazon at this point. Maybe at some point in the future. But even when the market corrects, these mega cap names, they're still your beloved stocks. There will be a rush for the exit, but there's just so much more money to be made in the stocks with smaller market caps, especially those that are overvalued and those with the most bearish chart patterns. These are clearly bearish chart patterns, but they're not, I'm not in love with any of these. And that's why you don't see these as short trades at this point in time. So there's Facebook, had a trend line there. It's broke down. We could revise it right there. So you really had this large wedge. Prices broke down, snapped back up, back tested, and seemed to be rolling over. This line runs parallel to the primary uptrend line here. And most importantly, there's that wedge. You can see the clear negative divergences. That's a daily time frame on Facebook. And here's the weekly chart on Facebook. It's been working its way up within this contracting price channel. And this is a pretty well-defined trend line here. You want to see this one go, and these are all support levels along the way. And then ultimately, I think this is a trend line that will probably come into play at some point in the future. So we can extend that one out. But again, these are stocks that at this point in time, I don't have any desire to trade. Here's Intel. It's not shown here, but I could draw it out. We had a divergent high right here. You can see we had a head and shoulders pattern. There was a neckline breakdown, very impulsive move. That was a divergent high, a small divergent high. Fast forward to today, we have a much larger divergent high. These indicators and oscillators still making a lower low, and prices are making a higher high. I should say lower highs here and higher high on price. And let's look at the daily chart. That'll probably tell us a little more. So try to hone in on the daily chart, give us a little more, a better idea on the timing. Again, I don't have any desire. There are quite a few semis that I'm interested in shorting again. We had a couple that were stopped out recently, and I think those will be excellent shorts on the first big leg down we get here. There's a rising wedge, pretty well-defined trend line. That probably shows well in the 60-minute chart too. We're looking at a daily here, but you can see the rising wedge. You can see it confirmed with divergences. And this was a pretty key former resistance, now support level around 35.61. This is an alternative trend line that'll probably find some support on the initial tags. I would think Intel is going to look something like this in the next couple of weeks here, very soon. This thing's ready to pop. This is getting close to the apex of wedge, so a little move down there. I don't even think the bounce would be that high. Down here, find some support around 35.60, and then ultimately go. All right, couple more, and that's it. I think the theme is pretty consistent. All these divergent highs that I'm pointing out here. This is Comcast. I don't have a strong opinion on this chart. There is quite a bit of, sideways action right here. So I think a break below this shaded range, below those lows. That's also that previous reaction high back here. You bring us down to this level, we have some pretty well-defined support right about here. And if and when that goes, let's see, we might be able to draw a trend line here on Comcast. I haven't annotated all these charts. This is not one that I really care to do anything with, but there is an uptrend line, 3-4 reactions and a breakdown. So it recently broke down. So, and you could probably draw some divergence here on this high right there. And let's see, weekly, what do we see? Well, there's a chart that speaks a little more clearly to me. This is a weekly chart of Comcast, same story, divergent high, powerful divergences, clean bearish rising wedge. There's that minor uptrend line, or what I call sub-uptrend line within the larger uptrend. This is the primary uptrend line. And, you know, that projects, well, here's our measurement. If you take the widest part of the wedge right there, add it to the point the wedge breaks down. I'm talking the bigger wedge, the primary uptrend line. Let's just say it breaks down right here. That would bring us down, you know, quite a bit. And this would actually be my target here. A little bit above that. I see some decent support around there. That $39 level, which is, you know, that would chop the stock in half, and I think that will happen over the next year or so. And ultimately, I wouldn't be surprised to see Comcast come all the way back into that $30 level. Cisco, well, I'm on a weekly time frame again. I'm jumping back and forth between daily and weeklies here. Two consecutive big, powerful divergent highs, pretty clear, and a very steep uptrend line. This one's probably actually looks like a nice short. Look at that steep uptrend line, divergence. Look at the daily chart. I'm sure it'll show through there. There it is. There's a nice bearish rising wedge. You know, we had a divergent high here, and as they almost always do, it played out for a nice correction. You know, you can see the drop from here to here. And now we have in another divergent high, rising wedge. Could Comcast work its way up within that wedge, make another divergent high? Absolutely, that's possible. But any high from this point, you can see if I extend these lines, any additional high, even if we get it within the wedge, another thrust, will still keep these divergences intact. It would take a heck of a move here to undo these negative divergences and bust up this wedge pattern. So there's one to watch. You know, if I don't have a price alert, I probably should set one. I may already have one. But that looks like a ripe for a short all the way back down. I can tell you targets if you're interested. Certainly a couple reactions there, and that level's at 30.20, and I think it'd be a good shot down to at least the 29.50-ish area in relatively short order once that wedge breaks. And last one, we'll wrap it up here. Amgen. There's Amgen. Nice divergent high. You can see here prices on the daily time frame making a higher high. Very steep divergences on the MACD, and it seems to have a hard time. Amgen's hitting a wall around these highs. You can see going back for years. This chart goes back 2 years. There was this brief overshoot here, but it keeps struggling to get above this, you know, 172 to 180 level, and it's failed it. These are all levels that I'm looking at, but then we look longer term. Here's what we see in Amgen. This is the story. This is our primary uptrend line, broke down, back tested, came back up, and we've failed to take out those previous highs. And as I mentioned, we have, I don't want to extend this divergence because that high was a little higher, so I can't really extend that divergence. But if we look at the biotech sector as a whole, here's what I see. This is XBI, one of several biotech ETFs, and yeah, this was our primary uptrend line. We broke down, smashed through impulsively. You know, in my opinion, this was the end of the bull market. Well, clearly, we had a big enough drop, and that was pointed out ahead of time. We had a tremendous short up on the XBI and actually LABU, the 3-time leveraged long biotech ETF. I think we covered that for like a 50-something% gain. And since then, it's wedged up. So what this looks like, if you take a look at the bigger picture, step back, I know the biotech seem tremendously strong this year, most of this year, which relatively speaking they have, but this appears to me, this bearish rising wedge is nothing more than a counter trend rally in a larger new bear market. You know, we're still well off the highs, not even close to those previous highs in the biotechs. quite a bit of resistance. And if you look, I have the Fibonacci. This line here shows the fib levels, this yellow line. Take that, go to the left, you can see all we've done is retraced. We stopped cold at the 50% Fibonacci retracement level. And that's, again, from what I'm measuring is the move from the highs down to the recent correction, the lows in early 2016. That first drop down, that first leg down in the bear market, and we retraced, hit the 50% retracement, which is a common retracement level in a primary trend for a counter trend bounce. And so far we've reversed off that level, and a break below this rising wedge pattern. We could probably look at it on the daily. I don't know. I'm not sure if I have it marked. Yeah, I do have it marked up. So there it is. There's looks like we're cracking below that wedge right now, and that's XBI. So we'll see. All right, guys, I'll leave it there. Well, let me just point out this most recent divergent high on the biotechs. There you go. All right, we'll leave it there, and something to watch. But like I said, just be ready and be flexible. You know, if these charts don't play out, if things go the other way, you know, we're not short the broad market right now. We're short a few individual stocks. We're long quite a few individual stocks, especially those with low correlation to the market. And you know, I may pump out. I still have a watch list a mile long in front of me, and just be ready because I may pump out trade ideas in very short order if this market suddenly makes a decision it wants to go one way or another. Okay, this has been Randy Finney with Right Side of the Chart. I hope you enjoyed it.